18 of 19 series are aligned with stagflation mild this morning. That is an unusually high degree of mathematical agreement across the framework. The current macro regime is stagflation mild, with a confirmation score of 18 out of 19. In regime terms, stagflation mild means growth momentum is decelerating at minus 0.6062 in our normalized composite, while inflation momentum is accelerating at plus 0.0081. The macro regime label simply names that configuration. Softer growth conditions alongside firming inflation dynamics, as measured mathematically. The coherence score is elevated, and the confirmation score of 18 out of 19 reflects very broad agreement among the 19 series that define the environment. Historically, regimes with a confirmation score in this range have persisted in about 52% of comparable cases over roughly 3-month windows, with the most common transition in the sample being a move into an acceleration configuration. Compared to last month, confirmation has stepped up toward the higher end of the range, while growth deceleration has deepened modestly, and inflation acceleration has ticked higher. In prior periods with similar stagflation-like conditions, price behavior in the data has often featured choppier equity returns, firmer commodity complexes, and range-bound to slightly higher nominal yields, though with substantial variation around those averages. Turning to individual signals, the Treasury curve is the first stop. The 10-year yield itself sits below the inflation composite trigger at 4.45%, and the curve configuration for T10Y2Y is green, which the framework defines as a positive 1-month rate of change in steepening that exceeds 0.25 standard deviations relative to its own 2-year history. In 9 of 11 comparable periods, when the 10-year yield approached this zone with a similar steepening impulse under mild stagflation conditions, the data set recorded further acceleration in our inflation composite within 6 months. That observation describes how the inflation composite behaved historically when the long end of the curve and the regime looked like this. On the labor side, the payroll employment series, PAYEMS, is red. In this framework, red means the 3-month rate of change in payrolls has turned negative and is weaker than 60% of history over the past decade after adjusting for volatility. In 7 of 11 comparable periods, when PAYEMS momentum was categorized red during a mild stagflation configuration, the historical record showed a drift higher in unemployment measures and softer consumption growth within the following 2 quarters. This is a conditional frequency in the archive, not a directional statement for current labor markets. Credit spreads provide a third lens. Our broad investment-grade spread proxy is yellow, defined as a flat to mildly widening 3-month rate of change that sits between the 40th and 65th percentiles of its 10-year history. In 6 of 10 comparable periods when spreads were yellow under a stagflation-light environment, the sample showed modest, further spread widening and lower average equity index Sharpe ratios over the subsequent 6 months. These are descriptions of how spread and equity data have co-moved in the past when the framework recorded similar math. For a fourth signal, consider sector behavior inside equities. The framework tags utilities as green, based on a positive 3-month relative strength versus the broad index that exceeds 0.5 standard deviations. In 8 of 13 comparable periods when defensively oriented sectors screened green alongside a stagflation mild macro regime, the data set showed more muted performance from cyclicals relative to the market over the next quarter. Again, this is historical pattern recognition, not trade guidance. 2 conditional markers sit on the map today. If the 10-year Treasury yield crosses 4.45% and holds there for 5 consecutive sessions, similar moves coincided with a clear acceleration in the inflation composite in 9 of 11 comparable instances. In the archive, those environments often sat near transitions into acceleration regimes. If the fear and greed index drops below 15 and holds that reading for 5 consecutive sessions, confirmation scores deteriorated in 7 of 9 instances, often around regime inflection points. The map is live. These conditions are being monitored daily across all 19 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as a potential long or potential short condition under the framework. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Atlas monitors 407 symbols independently of any regime label. Members study these outputs as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. Any action remains your choice. All of this is framed as may, potential, and educational. The morning brief is the public surface. The live Atlas dashboard shows the full 19 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.